Hey everybody, and welcome back to Investing with Wesley. You know, a lot of you have been asking me what are different investment strategies that you guys could potentially use to turn a profit. In today's episode, I want to talk to you about a couple different long-term strategies that I know about and some of them that I employ myself. That being said, let's get into it. Okay, so for starters, let's start with the type of investing that almost everyone already knows about, and that is passive investing. Now, there's a bunch of different pros and cons when it comes to passive investing. Passive investing consists of you buying into an index month after month or week after week, and you just long-term consistently buying and consistently holding, and you'll get the same results that this index usually gets. Now, when most people contribute to the passive investing strategy, more often than not, they're investing into the S&P 500, which averages anywhere from 10 to 12% annually long term. Now, when it comes to passive investing, there's a couple different pros and cons. One of the pros, like I already mentioned, is you get an average return of 10 to 12%. And another pro is that it's passive. You can just set it and forget it. You could set your portfolio to mirror the S&P 500, contribute monthly, and just forget about it. And many years down the road, odds are very good that you'll have a large sum of money, depending on how long you've held. Now, some of the cons are that as the market falls, so will your portfolio, and you're going to ride every down wave just as much as every up wave. And another con, albeit small, is that this strategy produces you the smallest amounts of gains in all the strategies that we're going to be talking about today. Now, the second strategy I want to talk to you about today is the other passive strategy. The first passive strategy of you investing in an index fund is kind of the DIY or self-investing method, where you select the index you want to mirror, you set up your portfolio, and you invest into it. This passive strategy is you let others do that for you. And more often than not, you see this in something like a mutual fund. In a mutual fund, a lot of investors pool their money together into this mutual fund where professional investors will invest for you, hoping to give you returns that are better than the market. Now, the pros of this is that if you are successful in picking a good mutual fund that has good investment advisors in it, you can see returns on average between 14 and 18%. Now, the cons are that it is much more expensive than the DIY investment way. And although your investment portfolio may be diversified, you still kind of have all your eggs in one basket because of the person managing that portfolio. Now, in both of these passive strategies, you can, in a sense, set it and forget it for extremely long terms. But in this strategy, where you're letting a mutual fund or active investors invest for you, you really can't set it and forget it, but you can set it and occasionally monitor it. As an example, for a while, the ticker symbol SHRAX was going up and was an amazing investment mutual fund. But after a certain point, the investments got too speculative, or the philosophy in the investors decided to change, and since then, it has done terribly. So you can't necessarily set it and forget it like you can index investing, but you would definitely want to monitor this one, because if you notice a consistent pattern of your investment going down, it might be time to change. Now, if you've been around this channel for a while, you'll know that this is probably my least favorite kind of investing, because the fees are astronomical and it's extremely hard to find a mutual fund that is successful long-term in what they do. It's much cheaper and much safer just to do it yourself and index the S&P 500. Now, the third strategy we're going to be talking about is the active value investor, otherwise known as the Warren Buffett strategy. Now, the Warren Buffett strategy will basically stack cash and wait for a perfect buying opportunity. Now, this isn't so much as wait for the dip and then buy, as much as it is researching a bunch of different companies, determining which one's best, and cherry picking 4 or 5 really good companies that you could see some solid growth out of, but that also meet all the fundamentals of a value company that also will produce a dividend. Now, again, this is a long-term play, because even Warren Buffett himself says he won't buy a company that he doesn't intend to hold for at least 10 years. So this is by far a long-term strategy. And assuming you're successful, you learn how to do it properly, you could see average returns like he does of 20% or more per year. Now, with any strategy, this one itself has pros and cons with it. The pros are that you won't participate in all the downfalls that you would if you were just indexing the market as a whole. And obviously, one of the biggest pros is that you're going to be doubling your average returns compared to what the market itself is going to be giving you. But the cons are that it takes a lot of time and effort to research these properties and learn how to do it successfully. And not only that, but you have to stay very disciplined, because you're going to have to pass up on a lot of potential buying opportunities until you find that perfect one. Meaning, if you keep some of these stocks inside your watch list, you could potentially see them all go up and give you double-digit returns, but you wouldn't have participated in them because you didn't actually invest in them. This strategy is solely about cherry-picking the absolute best companies when it comes to your value portfolio, and then riding that wave and that momentum upwards, giving you those 20% on average returns. Now, just on the other side of that coin is another active investing strategy, but instead of value, it is growth. This is the Thomas Price Jr. or Cathie Wood strategy of growth companies and speculation. And this strategy works pretty much the exact same as the Warren Buffett strategy, whereas you stack cash and you wait for a perfect buying opportunity, but instead of searching for value companies, you are searching for speculative and growth companies. Now, good growth companies have a whole different set of fundamentals compared to value companies. And this strategy looks for those perfect growth companies that are basically going to be the next Tesla, Amazon, or Apple. Now, in my opinion, this strategy is a lot harder than the Warren Buffett way, but it can produce some sizable returns. You just have to leave your ego out of it and take the profits when they come. I say this because if you look at Cathie Wood's portfolio, the ARK portfolio, ARKK, you'll see that the speculative growth really took off, but at a certain point it got too speculative and they no longer followed their principles and investing, and now since that peak it's lost over 60% of its value. But some of the pros is that if you do this properly, you could see average annual returns anywhere from 15 to 30%. So if you're successful, you could even get better returns than the Warren Buffett method. Just remember that speculation and growth are always way more volatile than value companies, so you're going to want to set up stop losses and collect your profits when they come. Otherwise, you risk losing 60% of your portfolio growth, just like that ARK portfolio. Now, another investment strategy that people do when talking long-term investing is the tangible-only strategy. These people don't really focus on stocks or bonds. They only focus on tangible investments, things like real estate, precious metals, agriculture, and art. Basically, this strategy focuses on tangible goods that will grow in value over time. And although a lot of investors will tell you that commodities are risky to invest in, that's actually not so much the case, assuming you know how to do it properly. Gold is a perfect example. Gold has actually outpaced the S&P 500 as a whole. So this investor could have just bought gold consistently, held onto it, and would have gotten better returns than if they just indexed the market like in our very first strategy. Some of the pros with this strategy is that you have tangible goods. You have real estate that you can rent out, and not only does your property appreciate in value, but you also get a little bit of cash flow from it. You can then turn around and turn that cash flow into investing into these precious metals or agriculture, and then use that to grow your portfolio over time. Now, it's really hard to give you an average annual return number because the price of commodities and the price of art fluctuate wildly. What I can tell you is that long-term, real estate follows the pace of inflation, and not only that, but you're building equity and have amazing tax credits and tax incentives with real estate investing. Coupled with precious metals like gold outpacing the S&P 500 can combine to give you pretty sizable returns long term. Now, the cons are that it takes a long time and a lengthy process to sell your home if you ever wanted to. And sometimes gold is not favorable in the markets and you may be selling at a discount. In other words, there's liquidity issues with this strategy as opposed to any other strategy out there. Now, the sixth and final long-term strategy that I want to talk to you about today is the sector rotation strategy, or the market cycle strategy. Basically, what this strategy does is invests in one particular sector of the market at a particular time. And how they do this successfully is to follow the business cycle. I made a video about this on the past, but basically when the business cycle is at a peak, the stocks or sectors that do well at a business cycle peak are often things like energy or consumer staples. So if you are a market rotating investor, then you would be basically all in on those two sectors. And then as the business cycle moved along, you would cycle in and out of different sectors. Now, obviously, this is a very active way to invest, so you may get charged extra commissions in your trading account depending on who you're trading with. So that could be a con there. But on the plus side, if you're successful and you spend the time to learn how to do it properly, you can get way, way better returns than if you just indexed the market itself. Like I said, indexing the market will give you anywhere from 10 to 12% annual returns, Whereas this strategy, if done successfully, can almost triple that. But also the downside of doing this method is that if you're wrong and you don't pick the most opportune sectors, then you could risk picking the most inopportune sectors and losing money rapidly. Now, finally, in closing, I just want to say that you may be wondering yourself if there's a bunch of different methods out there to beat the market and give you double-digit returns. Why do people still just decide to index the market, and why does that seem like it's the most recommended way to invest in the stock market? Well, this is because it's one of the only passive investing methods out there, and on top of that, it's the only thing that remains consistent long term. So you can, in a sense, set it and forget it, and 10 or 12% returns, if you're waiting long enough, will still give you plenty of growth into the future. So why spend a bunch of time learning how to do this if investing is not really your passion? Why pay people a bunch of money to invest for you if they can't guarantee their results? A lot of people recommend the index method or the passive method just because of that. It's a set it and forget it method that, if held long term, will give you sizable returns. Now, if you're asking me what my strategy is mostly the set it and forget it strategy, but I reserve a lot of cash for good value buying opportunities, as well as to participate in certain option contracts when a good purchase arrives. This gives me the indexed overall return with also the potential for a little bit of boost to, in a sense, just barely beat what the market is returning. I hope you got value in this video. If you did, please remember to like and subscribe because it really helps this channel get out there and grow. I have a dedicated Facebook and Instagram account, so if you ever had any questions or comments or just wanted something addressed, that's a great place to reach me. Either way though, the choice is yours, and I'll see you in the next episode.